Hello, welcome. Wanted to thank everybody for joining us today on another educational webinar that we have with a guest speaker here at Advanta IRA, talking about a little bit different topic, something we haven't covered before. But I think especially as we get into the numbers, you'll see is a growing industry and definitely something you'd want to be aware of for your investing. Again, whether it's IRA or non-IRA funds, definitely learning about investing in senior housing with Sara Jung is going to be the topic for today's webinar. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. Been with the company for a number of years now. I'm a licensed attorney in the state of Florida, although I don't do any legal work for any Advanta clients. But you're happy to reach out to me. My phone number, my email are here on the screen. Any questions you have regarding the contents of today's presentation or anything else related to self-directed IRAs, please do not hesitate to reach out to me again, either by phone or email. A quick disclaimer, Advanta IRA does not provide any legal, tax, or investment advice, nor do we endorse any particular investments. So even the webinars we do where we bring guests on like Sara today and other people we've had in the past, we don't necessarily vet any investment that they've done or that they might be promoting in some degree. So that you are encouraged to do your own due diligence. The information we're providing really is for educational purposes only. We want to expose you to just different ways of investing, different types of investing, but it is up to you to do your own due diligence, again, not only on the investments themselves, but then also the people that you're doing the investments with. As we go through the webinar today, I'd encourage anyone who's listening live, please type your questions into the question box on the screen. We'll make sure we get to those as we go through, or if there's time at the end, certainly go through and answer them all at once as well. Just a quick note about Advanta IRA. We've been in the industry almost 20 years. We hold over $1.3 billion in assets, and we've really set ourselves apart in the industry with our account manager system, providing concierge level customer service to all of our clients. If someone's looking to invest with Advanta, you're going to get one person assigned to you who will be your point of contact for anything you need regarding your account. You don't have to call an 800 number or wait in a long queue online in order to actually speak to someone to get some answers relating to your questions. We also try to really provide a lot of educational content. Today's event is part of our ongoing effort to provide as much education and information to our clients and prospects and other individuals in our sphere of influence. So we do that through seminars, webinars, networking events, lunch and learns. Some of the live events obviously have been on hold the last few months and will continue to be on hold for the foreseeable future. But that's why we've kind of upped how many webinars we're doing. We're happy to have Sara joining us today to talk about a new topic. So the customer service and the education is really what we really pride ourselves in providing. If you ever miss a webinar or an educational session, you can visit our on-demand channel on YouTube, our video library, and watch any recording that you may have missed. Just a quick note about self-directed IRAs in case you have any first-timers on the call, people who are interested in to know what exactly a self-directed IRA is. A self-directed IRA simply is a type of retirement account where the owner of that plan, that IRA, has full control over what they are investing into. They are not limited to the mutual funds, stocks, those types of assets you might typically find in a bank or a brokerage firm, where those companies do limit you to investing only in the products that they sell. With a self-directed IRA, you can invest in a large variety of different assets that are outside of the stock market. So you're avoiding the ups and downs that we've seen especially over the last few months, but even going back several years as well. You get the ability to put this money into something else that you know, understand, and you can control as well. So a self-directed IRA is really not a special type of IRA as far as like the traditionals and Roths and the SEPs that we'll talk about in a second. It's just the ability to invest in something that you have complete control over. Self-directed IRAs are great capital sources if you're on the call and you're looking to raise money. Potentially why self-directed IRAs are a good source, and certainly for people who are looking to use them as an investment vehicle. For people who are raising capital, IRAs can be a good source of capital simply because you can go to your existing database, your existing investors, and show them the ways they can use their IRA funds to invest in your next project, your next deal that you have coming up. So it's a good way just to reach out to existing investors and then therefore get a repeat investor when somebody chooses to use their IRA account rather than use personal funds or other sources of money that they have. Depending on the rate of return that you're offering, certainly many people are looking for something better than that 1 or 2%. They may have that they're earning inside a money market or a CD account. There's no outside approval needed. So if you're, again, looking to raise capital, if you're looking for a mortgage on a single family property that you're looking to flip, you don't have to go to a bank. You just go to that one individual who's going to make that decision whether or not to use their IRA to make that investment and lend you the money. And if they do, that's the only person that you're getting approval from. There's no other process other than satisfying the IRA owner on the legitimacy and the benefits of that particular investment. Another reason I think as well why IRAs are a good capital source, especially as we get into talking today about longer term real estate investments, investments where there might be a 3, 5, 7-year hold time, is that a lot of people are not expecting to use their IRAs anytime soon. They had this money is for their retirement. They may not be in retirement age yet, or they're not planning on taking any money out for the next 5, 10, 15 years. Making a investment into a private placement or senior housing, multifamily real estate, things of that nature, because if they're not going to plan on touching the money anyway, they're okay putting that money into more of an illiquid investment that has some type of hold period. So again, I think IRAs can be a good capital source from that standpoint, because some people would rather invest their IRA funds that they're not planning on touching for 10 or 15 years rather than dip into their savings account, which they have there for a rainy day and emergency type situations. As far as what accounts can be self-directed, any type of IRA, your traditional, your Roth accounts, the SEP, the simple IRAs, if you're a small business owner, SEP or simple IRA just allows you to make a much larger contribution on an annual basis. But in full, any type of IRA, traditional Roth, SEP, and simple can be self-directed. It's a matter of simply filling out the right paperwork to get that money moved over into an Advanta account where you can then in turn choose the investment. For people who are self-employed and sole proprietors, we also offer a solo 401k plan that again also allows for larger contributions than do the IRA accounts. It has some other added benefits as well that we're not going to get into today, but certainly give me a call for more information on that. And the other big bucket of money that can be self-directed that some people will miss at times is that those former employer plans, the old pension fund, the old 401ks money, when people leave their employer, that money stays there. It stays in that old plan until the client, the IRA, until the plan owner makes a decision to move that money. And so that money can also be self-directed as long as you are no longer working for that particular company. We talk about getting money moved over. So if you're deciding to self-direct, how do you get the money moved from your Roth or your traditional IRA with another firm or an old 401k? How do you get that money into a self-directed account? It's simple. It's either by doing a transfer, which is when you move money from one IRA account to another IRA account, or by doing a direct rollover, which is when you move money coming from an old 401k, old 403b plan, and rolling that money over into an IRA account. So it's just different terms. There's a little bit different paperwork and handling on how that happens. And that's something we certainly guide you in that process when you're getting your account set up here with Advanta. But both are non-taxable events. So when you move money from an IRA to IRA or from an old 401k into an IRA account, there is no tax consequence to moving that money from that other plan to the self-directed account. With transfers, that's something where we will initiate that request. You'll fill out a document with us. We send that form to your current IRA administrator, and they then submit the funds pursuant to the instructions on that form. For direct rollovers, typically you as the account owner will contact your former 401k administrator and request that they send that money to the new IRA that you've opened with Advanta. So transfers and rollers can take anywhere from a few days to a few weeks, just depends on the type of account that you have, whether it's an IRA or 401k. And again, we keep records on each custodian to give you a better idea of what might happen for each one of those. Now, in general, if you're somebody who's self-directing at all, you may recognize these reasons on the screen of why people choose to self-direct. Or if you're somebody who's considering self-directing, these are some of the reasons we've seen, at least I've seen over the years, having been in the industry now for 14 years, getting close to 15 here. In talking with people over the years who have chosen to self-direct and make this kind of part of their retirement portfolio and philosophy, for some people, the self-directed IRA is just a new source of capital. So if you're looking, say, we're talking about senior housing today, if you're someone who has invested in senior housing projects before, this is something that's not that new to you. You're here today to get a refresher on that topic and learn a little bit someone else's perspective on it. For you, the IRA just may be another source of capital. You've already made this investment before using personal funds, but now you come across a new opportunity, and the IRA just provides you with another bag of capital to use for that particular investment. So for some people, choosing the self-direct is simply that's where their money is. That's money that they have access to that they prefer to use. For others, it's the fatigue of the stock market. We've seen the market over the last few months go way down and come way back up very quickly. And a lot of people kind of have an idea, at least this time, why that occurred. But still, having had that happen and seeing how the effects that, in this case, a pandemic had on their stock market, on your 401k plan in a very short amount of time is unsettling to a lot of people. So getting some of their IRA funds into an investment that they understand, that they can control, is very attractive. And that's why some people choose to self-direct, really getting more true diversity within their particular account. And for some, it's the tax benefits, the income, the profits that you make on some investments in a self-directed IRA. They're all going to come back to you either tax-free or tax-deferred. So if I was looking at an investment opportunity with substantial returns and I'm in a higher tax bracket as an individual now, I may not want to make that investment using my personal funds because I'm going to have a pretty steep tax bill that particular year on that income that I'm receiving. And if instead I make that same investment using my tax deferred or tax-free IRA account, I'm able to not have that impact me now while I'm in that current tax bracket. So again, these are some of the reasons why people self-direct, and for some people, maybe all three of these apply to their individual situation. Now, today's presentation, we're going to be talking about real estate, which we do in a lot of our educational webinars. And the reason for that is most of the assets that we hold at Advanta, that $1.3 billion in assets that we're holding at Advanta IRA, probably 70 to 75% of that is in real estate-based assets. Anything from the more active investments, when you consider what's involved for the individual IRA or someone who's investing in single-family homes, whether for you're doing long-term rentals, short-term rentals, or even rehab projects. Those are a little bit more active. The IRA owner is probably going to have to be more involved with what is going on. Maybe being a liaison with the tenant, choosing contractors, things of that nature. So it's going to require a little bit more elbow grease, so to speak, from the IRA owner to invest in, say, a single-family home. You can certainly use a property manager though to make your life a little easier there. Certainly other active investments, the condos, investing in mobile homes and parks, people investing in tax deeds, again, takes a little bit more of your own due diligence on those different properties and involved the day-to-day aspects of that business. So we certainly see a lot of these types of assets in the self-directed space, but we also have seen a large increase, especially over the last few years, in some of the more passive investments. ALFs, assisted living facilities, and senior housing. Something we're going to talk specifically about today is definitely a more passive investment, and real estate investment trusts. And you also have your commercial and your multifamily properties. And the common thread with a lot of these investments is you're not typically investing or buying, say, an ALF or a multifamily piece of real estate just solely by yourself in an IRA, but rather you're going to be one partner in an overall larger project that may be taking the form of an LLC, limited liability company, or maybe a limited partnership, where your IRA is simply going to own shares and an ownership percentage in that particular overall structure. So it's more passive involved. You may do some due diligence up front before you place your money into the investment, but going forward on a month-to-month basis, there's very little for you to do as an investor. So when you talk about real estate, it's really there's more active investments, there's more passive. There's really no right or wrong answer on which one's better than the other. It's really more a personality thing for the individual IRA investor. What am I more comfortable doing? Do I want to be more active and be more involved and know that that's going to take a little bit more of my time to manage that investment? Or would I rather sit back, more passively invest and then not have to worry about the day-to-day things, but I also won't have nearly as much control? So again, that's just some thoughts for individuals who are investing. You may already know what bucket you fit in, or maybe there's certain investments you do a little bit of both of this. But today we're going to talk, we have our guest speaker today is Sara Jung with Legacy Bloom Investments. Sara is going to talk specifically about senior housing. I think it's a very interesting topic. I'm very curious. I've already seen some of the slides in advance and some very good information that Sara is going to present on senior housing. It's definitely, I think, as we recognize that the population in our country, or there are large segments of our population that are getting older, senior housing has definitely become more in demand. So at this point, Sara, I'm going to turn this over to you for you to share your slides. And how are you doing today, Sara?
I'm doing well, Scott. Thank you so much for having me today.
Great. Yeah.
So,
So your slides are up, and I'm just
is
give
it
me
up?
one second.
Okay.
Let you introduce yourself. But before that, just to remind everyone who's participating live, if you have any questions, either for myself or for Sara as we go along, type those into the question box. I'll be monitoring those and be happy to reach out to you. Happy to include you, obviously. And Sara, I might interrupt as you go along with those questions. But again, if you're listening live, type those questions in. We'll make sure we get to them as we go. But Sara, why don't you introduce yourself and then take it from here?
Thank you so much, Scott, for having me. And I just want to mention to everybody that I worked with Scott with my clients, and his company does a really great job really in educating his clients. So I really appreciate the opportunity here today. So my name is Sara Jung. I am CEO and founder of Legacy Bloom Investments. We are a commercial real estate syndication company, and a little bit about on my background. I've been in real estate for about 20 years. I have about a 17+ year background in mortgage banking, finance, and lending. I specialized for several years in new construction and did several years in affordable housing projects. And in 2018, became in the top 1% nationally. So I've done a lot of real estate transactions over the years and got involved with real estate investing myself personally for the last several years in both residential and multifamily properties. My company partners with experienced operators across the US with multifamily and senior living projects. What we do is we partner with those experienced operators, bringing in opportunities for our investors through private placements through a process called syndication. So our investors are able to share in the cash flow and the equity once we sell the property, and in some cases are able to take advantage of the tax benefits through the depreciation. I partnered with a senior living team, and I'll share a little bit more about them, and they have a 16-year track record in developing, managing, and operating senior living communities within assisted living and memory care. And I'm going to show you a few examples of these projects that they have built and operated, and I'm going to go through and talk about senior living and what's involved and how it works, and some aspects of what's going on with senior living in the industry today. Really quick though, before I get into that, I just want to share a project that we just closed. I just closed this in December with an experienced operator, and this was a 200-unit apartment in Melbourne, Florida, in the Orlando MSA. This was a value add project. We did a $14 million raise, and the purchase price on this was $35 million. This is just an example. I just want to show you some of the projects that I work on with my partners. And this was a beautiful property, about 80% ownership that we gave to our investors. And as you can see here, we had a really great return with a good cash on cash return. This was a 5-year hold. So this is just an example of, again, of just some of the projects that I work with my partners on. So let's talk about senior housing and why senior housing and why you should consider investing in senior housing. So senior housing, there's actually a spectrum of senior living. And when you think about senior living, many things might come to mind. But I just want to show you the spectrum of senior housing and kind of where it starts. So on the lower end of the scale, as you can see, if you start on the left, it's more of age restricted. You don't really have care needs, but as you go down the line, your requirement for needs services increases as well as cost. There's two components of senior living, and the first one is the real estate component. So from the real estate side of things, you would buy a property just as if you were just buying standard real estate. But then you have a second component of senior living, which is really important and really is what the distinction is. And that's really providing a business service. This is really a needs-based service industry. And you have a component of skilled nursing that's involved. So different from multifamily, senior living really requires a little bit more specialty and definitely an experienced operator in this space. The first part is 55 and older. Many of you might be familiar with that, and that's real estate only. Typically, there's amenities designed for the seniors. There's no care involved. And then you go to independent living communities where you might have some basic needs that are provided. They might provide some transport services, meals, just some basic things, but generally speaking, the residents are fairly self-sufficient. Then you move to assisted living and memory care, and this is where the skilled nursing component really plays in. You have assisted living where your residents do need some basic care on a daily basis. They might need some help with their medication, preparing food, bathing, and whatnot. And then you also have another component of memory care. Now, assisted living and memory care tend to go together. You'll find that in many communities will offer memory care in addition to assisted living. And I'll go through a slide later that talks about the percentage of Alzheimer's and dementia. It's actually pretty astounding. Then on the last, kind of at the end of the spectrum, you have nursing homes. For our purposes, we do not focus on nursing homes. We focus on independent living, assisted living, and memory care. And nursing homes, again, are going to be on the highest, on the spectrum of the highest cost, and in some cases can be very cost prohibitive. So with the nursing homes, again, I just want to mention that nursing homes tend to be for short-term, post-acute and chronic care needs for residents. So if you have somebody that's recovering from maybe surgery or some type of illness that they had from the hospital and they need more intensive care, that's where nursing homes would come in. Independent living, assisted living, and memory care do not have that requirement. So let's look at the demographics of seniors and how our country is aging. What's really astounding is that if you look at where we're at now and we look at moving forward, what our population is going to be looking like here in the next 10, 20, 30 years. And baby boomers started turning 65 probably 2010 to 2011. And that generation right now is probably in their mid 70s on average. In the next by 2050, the census has actually projected almost a $90 million increase in the population of this age group. Just in the next 10 years, we're expecting another just about 18 million or so. So the opportunity here is tremendous, and we're still at the ground level of where this is starting. So let's look at the inventory and supply challenges. So if we look at where we're at and we kind of look moving forward again the next several years, based on inventory and supply, it's projected that we're going to start seeing a supply shortage here in the next several years, and that's just going to grow. And so by the time that people start reaching 85, there's a projected amount of housing that we're going to have a shortage on. This is an inventory chart. So based on the average of 4.1%, we're actually at a 30-year low for inventory growth. And based on pace of construction and development of new communities, this is keeping this growth low. We can't build enough homes fast enough for this aging demographic. Senior living also has higher than average returns. If you look at the multifamily returns, senior living has historically had actually a higher percentage of returns than some of these other commercial properties. And on this graph, it's showing over a 6% increase. And on this next graph here, I'm going to show you the capitalization rates for senior living are significantly higher. This is actually showing the capitalization rate compared to the 10-year treasury. Senior housing typically has an average of about 8% capitalization rate. And if we look at multifamily, the average multifamily now, especially in the last several years, is lower. You're probably looking at 6% for multifamily. So again, it's just a lot of great opportunity for our investors to make better returns and higher returns when even comparing it to other assets.
Hey, Sarah, if I can just jump in before you go, just kind of what do you? I mean, you may get into this, and I apologize if you do. But what are the reasons, I guess, maybe why the senior housing, the cap rates are higher and the returns are higher? And again, maybe this is this slide here talking about the occupancy. Is it less turnover? I guess we kind of go into some of the factors of why senior housing is seeing better rates of return than, say, multifamily is?
Well, I think there's several reasons, but a couple reasons that come to mind right away is the average time frame for a resident to stay in senior living is about 2 years. So the turnover rate is not as high as you would see in multifamily. The other thing is that the cost per bed, because it's not based on per unit, it's based on per bed. So the cost of a resident to stay in a home averages about $4,000. And so just between the cost per bed and then the average turnover, along with the occupancy rates for senior living, have shown to have produced the higher returns over the years. And obviously those capitalization rates have fluctuated over the years, but overall, though, when we compare the two assets, it has been significantly higher. This graph actually shows occupancy averages comparing with multifamily, hotels, and retail and office. So senior living averages about 87 to 90% occupancy. Multifamily is a little bit higher than that, but again, seniors tend to stay in these resident homes for about 2 years on average.
Okay, yeah, thanks for that. So, and again, anyone else has any questions as we go along, please type them into the question box as well. In fact, we had one just pop in. Someone asked, is the higher cap rate due to the services being provided in the NOI or net operating income? If
That's
you can address
correct.
that question. Okay.
Yeah. So the NOI consists of, so again, this is a needs-based service. So there are higher expenses. There's about a 70. So typically the rule of thumb is about a 70% with a 30% margin. And so with multifamily, it tends to be more 50 to 60% or lower. And so you have, because you're providing needs-based services, you can charge a higher amount of income. You can charge a higher amount and produce more income. So the income, then the NOI on these particular projects are going to be significantly higher than compared to looking at a multifamily deal. Does that make sense?
Yep, it does. Yep.
Okay.
Somebody asked a question. We can maybe address this later. You can someone just want to know, do you have to be a qualified investor to invest with this company? So you don't have to address it now, but maybe just keep in mind later if when we get into that, what requirements are maybe to be a particular investor, whether it's accredited or qualified or whatever the terminology you may use is. But I'll bring that one back up.
Yeah, sure. We can address that at the end. I'd be happy to.
Okay.
So when we look at the cost of healthcare, the cost of care in general. So this is from Genworth. This is showing what the average cost is for if somebody were to do healthcare, whether it was adult daycare or assisted living or nursing home care. And when somebody's considering, when you have a resident that's considering if they're going to go into a facility, keep in mind that a lot of these residents, they go there. This is not an optional choice for them. This is really required for them because they're in a position where they need to have care. And so the other thing to remember is that they're not going here necessarily voluntarily. They're going into these facilities because their family members are not able to take care of them and they have specialized services and they need more attention. But when considering the cost, it is expensive to go into a facility or to an assisted living memory care facility. But when you look at the cost of if that resident owns a home, if they're having to maintain that home and pay for their other living expenses, when they go into an assisted living memory care center, it's typically an all-inclusive type cost. So they're not only getting the housing, but they're also getting the needs-based services that they need. When we look at who pays for these premiums, the majority of the residents do pay themselves. Keep in mind that by the time they get to this age, many of them have accumulated enough assets, whether it be in their home, their retirement funds, or brokerage accounts or other assets that they may have. And the next segment is typically family. Again, it's very common for family to contribute as well. And then there's a portion that insurance and Medicaid will also contribute, again, just depending on the situation that they're in. One thing that I thought was really important to think about was the wealth succession in our country right now. So we're on the brink of having the biggest intergenerational wealth transfer in history. The baby boomer generation is bringing the biggest percentage of wealth that we've ever seen. So we have about 7.5 trillion in wealth that will be transferred from the baby boomer generation to the next. And what's really sad is that by the time that it gets into the next generation, we actually lose about 70% of that wealth. And then in the next generation after that, it actually goes down even further. So one thing to consider is when we're looking at investing in senior housing is really not just investing for the purposes of ourselves personally to make the returns, but also that senior housing is a meaningful investment. So we're investing back into the generation that took care of us. So the industry definitely has some challenges. We definitely have more challenges even now with COVID. And this is from Mark Samilichap's slide that I thought was really resonated with me because there's a lot of headlines out there that talks about that instills or that can instill fear in us about how it's going to affect senior living and just our lives in general. And so there's definitely challenges and impacts. About 11% of the cases in the U.S. were in long-term care facilities. The silver lining in that was that the employment rate was actually better because if you think about it, the staffing that is required at these assisted living communities are required, again, as this is not an optional thing for them. So this is a very medically demanding model, and I think moving forward into the industry, it's going to be very interesting to see how things develop and play out. But as we speak, operators are working diligently on changing their processes and as far as with the COVID impacts now, and actually changing in how they're interacting with their residents, how the families are interacting, what kind of policies and procedures are being put in place, and the other things that they need to be doing to keep their residents safe moving forward. But I wanted to just mention that it's very easy to get caught up in the headlines of what's going on about COVID. But behind the scenes, I just want to share that a lot of these operators that I've spoken to, this is a very serious matter, and they're doing some drastic measures to change their policies and procedures. Keeping care affordable is a big challenge in this industry. As healthcare costs go up, the cost of senior living will also go up. So managing the staffing and the resident ratios while providing quality care at the same time is a continuous challenge. Also, there's a lot of senior housing projects that are fairly aged, and so we also need to consider moving forward what is going to be popular, what is going to be needed, and what our residents are going to want. Because again, something that may have been popular 20 years ago may not be the case moving forward, especially with technology growth today. There's so much technology built into our newer communities that some of our aging communities that do not have.
Yeah, Sarah, I have another question that came up in mind when you just talked about that specifically just now. So I know in multifamily there's A, B, C class, even some D class multifamily projects, which depends on kind of the newer to the the value adds where you need to come in and do a little bit of work. When you're looking to invest in senior housing, Lisa, obviously you're asking for your personal opinion on it. Do you typically stay away maybe from some of like what could be equivalent B or C class because the cost of say rehabbing or getting an older building up to standards for kind of assisted living is different than maybe what you're looking at from nursing home? How much does that factor into the type of property that you would want to invest in when you come into when you look at it from a senior housing perspective? Because obviously when you talk about nursing and facilities and things like that, there's definitely more involved in paint and carpet and new appliances or something like that with a multifamily project.
Yeah, and that's a good point, and that's something that we talk about with our partners all the time, especially when we're vetting out deals and looking at new opportunities. So the opportunity in senior, so we have, you'll find that a lot of senior housing projects are going to be new construction. There's a lot of the existing senior housing facilities that were built by the big box builders, and when we go in and you look at an existing housing facility, obviously we go in just like with any real estate property, we go in and we want to see what needs to be done, what we do full inspections. You want to see what kind of cost is going to be involved to bring that property up to speed, and that's no different than any real estate property. With senior housing, I would say that from an operational standpoint, you want to make sure that there's the demand in that area. We have run into some assets that have been distressed and actually were foreclosed on. And so I think looking between multifamily and a senior housing asset, it is different, and it's very important to bring in an operator who who understands how to work in that space.
And
There was another part of your question, Scott, that I didn't quite catch.
No, you did. No, that was good. And so I guess part of that, kind of when you talk about the importance maybe of then working with the right operator, I'm assuming can be huge, because if you get somebody who's looking at it as a multifamily situation as opposed to the ins and outs of senior housing and what's important, how would somebody vet, an operator from that perspective, from someone who's looking to do senior housing? What kind of things should someone be looking for in that operator that is looking to do a senior housing facility?
Yeah, so just like vetting out any operator, you want to make sure that they have a track record and the experience of the asset that they're managing. So with multifamily, obviously, we're vetting out the operator in terms of their history of management, what kind of track record they have. With senior housing, and so that's from a real estate perspective. So with senior housing, remember that we have that second component of needs of a business service that we're providing, and it's a needs-based type of care. So having an operator that has had experience with skilled nursing and understands the regulatory environment for what's required, because there's a lot more regulatory rules in senior housing than there is in multifamily. Again, because having a medical needs component to it adds more complexity to being able to operate the asset. So our partners right now, actually the team that we're in now, have a 16-year track record in operating and managing senior housing developments. They specialize in the assisted living memory care space, and they own all of their staffing. All of their staffing are specialized and especially trained in senior housing and how to staff and take care of their residents. So again, there's a lot more complexity to it. A lot of that is regulated, and so just having somebody that understands the regulatory environment and what's required is going to be really critical.
I was gonna say, and do you typically find that some of the operators is almost like a team, where you have one person who's maybe more focused on or more knowledgeable on the real estate component, but then you also maybe have somebody who's got somewhat of a medical background or is a medical professional that's focusing on that aspect because obviously especially if you're new construction, there's the aspect of choosing the right location and what goes into actually building the structure. But then you also have the person who's maybe it's on a board of directors or something that has, hey, here's what we're going to need from a medical standpoint. As you mentioned, the regulatory aspect, I'm sure, is huge as well. So is that typically what you'll see, is like a kind of almost like a multi-headed, operator with a couple different people with their own areas of expertise?
Yeah, and that is very common. But I want to point out that that assisted living and memory care is not as skilled nursing heavy as a nursing home facility would be. For example, we actually ran across an asset that was foreclosed that was actually owned by a doctor. So just because they're in the medical field does not necessarily mean that they're going to know how to operate it. Having some medical experience, I think, is very helpful and valuable. But I think what's going to be more important is, again, keep in mind that assisted living is needs-based care, but it's not to the other spectrum of having a nursing home where you are required to have a full-time doctor on staff. Assisted living memory care, you are required to have a full-time RN on staff, and then as far as the caretakers, they are required to have a certain amount of training to be able to take care of the residents. So from that perspective, you don't necessarily need to have a medical background to operate an assisted senior living memory center. What's more important is understanding how the industry works and how to work with the regulatory environment to make it successful. So I think the combination of having somebody who is an expert in real estate and then also having somebody who's an expert and has a lot of experience in the senior living space, but not necessarily having a medical background is required, if that makes sense. And so our team right now actually encompasses, we have several people involved. we have a very people on our team who are very active in real estate. And then our two other partners are experienced in the senior living development and operations. So together, so I think it's actually, so having that is a great fit, because remember, we have the real estate component and then we have the needs-based component of it. Does that help?
No, yeah, I think that was an excellent explanation. So yeah, just again, I've done a number. We've had a number of people come on and talk about multifamily properties in the past. So yeah, I just want to make sure to have that distinction that we're drawing between that. So yeah, please carry on. And again, if anyone has any other questions, we've had a couple come in, but I'm gonna hold the ones I have so far to the end. But again, any other questions people have, please get them written in.
Okay, great. So some of the demand drivers of senior living is obviously the biggest one obviously is the aging population. This is over a $300 billion market and growing. And when we look at the mortality rates and the percentage, the increased percentage of having needs-based care, and also just the choice of people wanting just a simple lifestyle. So between those, we're finding that these are the big drivers. So again, as we've talked about before, senior living has proven to be a very resilient asset, being able to withstand even higher interest rates, although interest rates right now are at an all-time low, but they're able to provide higher yields. Even during the recession back in 09, 010, the data showed that senior living was actually, again, provided higher returns than even multifamily. The average age to enter an assisted living facility is about 86 years old. The team that I work with, this is right in line with their data as well. The average age of their resident in their communities is about 87. So we're looking at, if we're looking at seniors turning in their, going into their 80s here in the next several years, we're going to be coming up in the next 5 to 6 years. We're going to be looking at kind of going right into the meat of where the opportunity is in this space. What was really interesting was what's driving the memory care. And when we look at dementia and Alzheimer's rates, what's really astounding is that we have 32%, and this is according to the National Alzheimer's Association, but 32% of residents will have some type of Alzheimer's or dementia-related disease once they turn 85. So that is just, I mean, that's a huge percentage. And we're also finding that in these communities, the demand for memory care is going up. And so there are some markets that we're finding that the memory care is actually almost in more demand in some cases than just the standard assisted living need. So again, that's just where this opportunity is going. The other thing that I want to talk about or point out is the opportunity in the secondary and tertiary markets. So a lot of the big box, the big box companies have built these pretty large senior living assets, and but the opportunity for us really is in these smaller markets. And what the studies show is that the majority of residents will move into a senior living facility within about a 5 to 15 mile radius of where they live or where they've grown up or where their family lives. So when you look at a lot of these secondary markets or tertiary markets, or even in primary markets, but you are going into more of the suburban areas, there's going to be a lot of opportunity moving forward to be able to develop and possibly reposition some assets for senior living. So again, just to support the opportunity for senior living, looking at the demographics, again, just looking at the next 10 years moving forward, we're looking at a significant increase of people turning 65 and 85 years old. And so again, starting now, we're looking, if we invest into an asset now, and we're looking at an average hold of about 5 years, we're just going to be kind of going right into kind of the meat of where this opportunity is going to be. So Scott, this is the end of just kind of the general senior housing presentation, but I want to address some of the questions before I kind of go into my example deal. Was there some other questions out there?
Sure. Yeah. Yeah. We did have a couple before we get into the actual deal and some of the ones that I mentioned earlier. Someone did say, do you have curious of any male-female percentages when it comes to senior housing. Do you have any kind of demographic information on that, or anything you maybe it wasn't in the slides that you could share?
So demographic information in terms of how many men versus women that reside in these facilities?
I believe so. Yeah, the question just said curious of male-female percentage. So that's, yeah, I'm taking that to mean, kind of a breakout based on those lines of the demographics and people looking for senior housing. And he just said
Yeah,
correct. That's what he's looking for.
yeah, that's a good question. I don't know what the national data on that would be. I think that's something that we could, that would be interesting to look up. But I could tell you that in the communities that I have with our team, so they have several communities in Tucson with one in Florida, and the majority of their residents are from the data that I have from them on their communities, the majority is female. So that's what I've learned so far. But again, from a national level, that could be different. And I think that would be an interesting statistic to look up.
Well, and it may make sense. I know that females typically have a slightly higher life expectancy than males, so that would make sense if those percentages bear out that same way. So,
Yeah, I would agree with
um,
that. So women are living longer than men typically.
yeah. So, someone asked you, do you develop senior living facilities in Georgia, or like do you have specific places you're? So let's take that a little bit broader. Is there anywhere specifically locations, or is it kind of project specific? If, hey, this project makes sense, doesn't matter where the location is.
Yeah, Scott, it's really project, it's really where the project makes sense. And, because depending, I mean, you can go into all different kinds of markets. When we talk about multifamily, there's other markets that we prefer for multifamily. But when it comes to senior housing, I mean, we've actually ran into projects that have been in where you would never, think about buying a multifamily because it's really very remote, kind of out in the middle of nowhere with all these small towns. But what we've actually learned is that in these small towns, there's actually there's a need for senior housing because even in the small towns, people are still getting old and they still need a place to go. And if they have dementia related diseases or if they need assisted living help, then these projects we have learned tend to fill up fairly quickly. So it is, I would say it's going to be project based. We do want to look at the market that it's in. You still want to be, you still want to have the basic fundamentals of any asset. You want to make sure that the market is robust enough to support the project that you're going to be going into.
Yeah, I was going to guess that was going to be your answer on that because, yeah, as you said, people are getting older everywhere. Multifamily may be, hey, you're looking for people who are moving to, but in reality, a lot of people, especially people who are getting in their 70s and 80s, maybe are not. That's not the time of their life when they're interested to start picking up things and moving. They're in their home cities, they're in their home states, and they don't really have a desire to go anywhere much further than that.
Yeah,
But they're
and
going,
you,
but they're
and
going
you
to need, but they're going to
look
need
at
a
the families.
facility to live in.
Exactly. And you look at the families and and you think about it, where are you going to put mom and dad when you're not able to take care of them? A lot of the families right now, I mean, there's a large percentage that do try to take care of their parents, but it becomes such a physical and financial burden that it's actually in their best interest to put their parents sometimes in a facility, even if they don't want to. And we've actually had families who have moved their parents even across states to facilities just because they didn't actually have any facilities near them. And
Hmm.
so, so again, even being in a market that's a little bit more remote, but that has maybe, a bunch of small towns, that those are still opportunities, for having senior housing.
Sure. Yeah. And as we get to, I guess, a specific project you're going to kind of use as an illustration of all this in a second. Somebody asked, I think this might tie into what you're going to do, but are there ever any advertising costs associated with senior care? How do seniors choose where and what care facilities they reside at? They're curious on how vacancies normally be filled. Obviously, that's part of the business plan of when you're establishing a facility or building one. So what kind of goes into that? Basically getting the word out. Where's the advertising? I'm sure that's all part of the budget. Is obviously filling the beds once you get them built.
Yeah, good question. So just like any business plan, it's important to make sure that you have a good marketing plan of how you're going to be leasing up a project, especially if you're doing new construction and you have a couple of years or a year to plan it out. So what we have found is that leasing up a senior living facility is very organic in nature. It's not just a matter of like with the multifamily, you put out an ad or you put it on apartments.com and or you put it out on social media, and all of a sudden you just have a bunch of calls. Senior living, the marketing on it is actually is really more word of mouth and by reputation. So when you're living in a community and in the senior living, a new facility pops up, what you want to do is make sure that you have a very robust marketing plan on being able to market it in that local community, and by networking even with other senior living facilities, possibly with the local churches and any venues that you can get the word out that you have a facility available. And so it is very much that we have found it's by word of mouth. It is also advertising. You can definitely advertise, and you definitely do want a social media presence because these decisions of where their parents are going to be going is made by the adult children in most cases. So when you look at where the adult children or where the adults are looking at as far as where to put mom or dad, there are some bigger kind of third-party agencies, like you have a place, I believe it's called A Place for Mom, that will give out referrals of various senior living facilities in the area. But again, we have found that even for our project that we're working at now, it's an organic process, and you need to have staffing and a director there on the ground to get the word out. And then it really goes by word of mouth from there. So I would say that based on our experience, that's probably the most that's probably the most prevalent. Especially when we compare to multifamily, like a lot of us might be familiar with.
Yeah, and so the two other questions we have so far up there, and then like I said, I think there's a lead good into what your last few slides are here. So again, the question I asked earlier, do you have to be a qualified investor? So maybe go over the qualifications to invest in certain private placements, maybe this one in particular. And someone's asking, what's the entry capital? So, what are the minimums people would be looking to? So maybe however you want to handle, if you want to answer the questions first, or if you want to introduce, show the example of the project that you're currently working on, I'll let you take it from there. But those are the two questions we have as of right now.
Okay, great. So let me just what I'll do is I'll just transition into my next slide here. And what this is so this is a sample project that we're working on right now with our team. And this is a project to kind of give you a flavor of what a new development project would look like. So this is in St. Louis County, and it's called the Cottages of St. Louis County. And this is basically, it's a 80-bed assisted living and memory care community. This project is a little bit different than what you might see out there in terms of other communities. This is a small house model. So what we're doing is we're going to build 5 separate homes. And these homes are not small. These homes they're residential in style, but the homes themselves are about 8,000 square foot each. And they're designed to house about 16 residents each. And they, as you can see, I don't know if you can see on the right side of the slide, a little bit of the layout there. So we have the dining, the living, kitchen, kind of the main living area, and centered in the center of the home, with the bedrooms along the perimeter. And in this one, we have designed some of the units are double rooms, and then the other ones are single rooms. This is on a little bit over 6-acre property in a residential neighborhood. What's kind of interesting is that there is a multifamily that's across the street, but the rest of the area that it's in is in the housing stock in this neighborhood is probably about 30 to 40 years old. So we're in a it's primed for senior living. There are some other residential or senior living facilities around the area, but not very many. And the feasibility study that was done shows that the memory care demand is going to go up almost over 10% just in the next 5 years. So we're right on the brink on this asset to, once we put this in place, that we are expecting a pretty much a pent-up demand, especially in the memory care space. So this one is, let me talk a little bit about the investment. The minimum investment on this deal, for example, is $75,000, but it really depends on the project itself. We have some that you're going to have lower minimum investments, and then you'll have others where there's a higher investment requirement. So it really just depends on the actual project. There's projects that you need to be accredited. If you are accredited, you need to, there's a requirement by SEC to make over $200,000 a year as an individual, or $300,000 as a couple, or if you have $1 million or more net worth, not including your primary home. this particular asset we are doing as a 506B, so we would need to, you do not necessarily have to be accredited, but we would need to vet out and make sure that the investor is savvy enough and has done previous investments to be able to participate and make sure it's a good fit for that investor. And of course, we are taking self-directed IRA and 401k funds and self-directed IRAs into this as well. I just want to show you some other, so Scott, hopefully that answered the question.
Yeah, I think it did. Yeah, for the qualified investors, like I said, the 506C, that's something just as an individual investor, you need to know the differences between sometimes those entities and what's required, whether it's accreditation or different qualifications. So, but yeah, that's something when you're looking at these types of projects, we're asking someone like Sarah, hey, what do I need to qualify? Is what you need to do to ask that question. And what typically, when someone says yes, I think I qualify based on what you told them, what kind of verification procedures do you do? Do they have to show you copies of tax returns or financial documents? They're basically signing, just affirming that they are indeed meeting those requirements.
Yeah. So if there's a requirement to be accredited, we use a third party for the verification process. We do not personally require any documentation or ask for any financial documentation. That's actually all done by a third party service. And so in many cases, what we actually get is they'll request a verification from your CPA or financial advisor to just verify that you would qualify as an accredited investor.
Okay. Yeah, someone asked kind of what are the historical returns that you've seen on these projects? I mean, obviously you gave some guidelines what you're expecting with the cottages, but do you have any kind of historical returns that you've seen on some of these deals?
Yeah, so when we look at some of the historical returns, I would say somewhere between 15 to 18% is pretty typical, but it really depends on how the project is structured with the limited partners. So, for example, on that particular project, there's a split with the limited partners that might be that's actually lower than what you would normally get on a multifamily. But the returns on that are going to be about 18 to 19%. And so it really, I would say that's really just going to depend on the specific deal. But historically, if we look at the overall returns of previous deals, I would say a good rule of thumb would be a 16 to 17% at very minimum.
Okay, and yeah, as I'll let you wrap up. So the other question, somebody had said investment income by the IRA would be subject to UBIT as you're investing in an LLC. And for people who are listening, yeah, if you're invested into a project using your IRA where there is underlying leverage, then your IRA account can be subject to, it's called unrelated business income tax. If you instead decide to use, we also offer that solo 401k here at Advanta, the solo K, and using that type entity, the benefit is that UBIT typically does not apply to those leverage situations. So if you're considering an investment into, again, multifamily, or in this case, the senior housing where there's underlying leverage, UBIT is definitely a consideration to think about. But Sarah, I'll let you get back, kind of explain kind of some of the things you've seen in the past.
Yeah, so so the team that I'm working with, I just want to show you some of their communities in their portfolio. So these operators, again, have, they've been doing this for over 16 years, a lot of experience. They built out several of these communities in the Tucson market, and they've expanded into Florida. And then also we're working on this next project in St. Louis. So these are three that I just wanted to show you that are in the Tucson market, and these range from 90 to about 140 beds. But and the one was completed in 2014, and their last one was in 2018. The one that they have in Florida that I don't have on here is actually going to be completed by the end of the year. And what's really interesting in their model is that because they're building individual buildings, that each time that once the individual building is completed, they're able to lease up. So it's a fill as you build model, as they say. So as soon as each house is done, they're able to fill that house and then continue building the subsequent houses. The villas at Spring Valley, I actually toured a couple of weeks ago, and it's just a beautiful community. And as you can see just from that one picture, and again, from what I can show you here, again, we're looking at high-end finishes, These are, we would, they would actually tell the residents, well, would you rather live in $1 million home or would you rather live in an apartment? And it was kind of a joke, but it's actually true. So when you actually look at this home and you walk in it, it's just absolutely gorgeous, and the setting that it's in is beautiful. So when somebody's looking at moving into here versus going down the street into maybe an older multi-family, or sorry, multi-unit senior living facility, in most cases they have chosen to go here. Okay, Scott, so that's the end of my presentation. And I would encourage everybody who's on the call today to contact me, contact our team if you have questions. If you are interested in investing with us, please contact me or go to our website and register, or just shoot me a quick email. And if you have any other questions about senior living or any other multifamily assets that we might be involved in, I'd love to hear from you.
Yeah, Sarah, great. Great information. Thanks for presenting today. We do have a couple more questions here that came in right as we were finishing up that last slide that I want to get to as well. But yeah, I would encourage anyone you have questions on today's presentation, definitely reach out to Sarah and her team to get some of that information. Good question. I was talking about the UBIT issue a minute ago, and I was discussing it from the fact that the projects might be leveraged. But the other thing, good point that the attendee brought up though, is the investment into this LLC considered, is the LLC considered more of a business activity as opposed to a passive investment? Because that's another way that UBIT can apply, is if your IRA or even a solo 401k was invested into a business like an LLC or a partnership. So is the senior housing and the ALFs looked more as a business or looked more as real estate, I guess, and maybe you don't know the answer to the question. I just thought I would throw that out there.
Well, that's a really interesting question, because in the beginning we were talking about how this is kind of a two-part structure. There's a real estate component, and then you have the needs-based assisted living or kind of needs-based care component. So I would say it's both. It's both. You need to understand the real estate, and then you also need to understand the business service side. So I would say that it's not just one or the other, but both.
Okay, and then I'm guessing the investment that is structured, people are buying into an LLC, and then ultimately they're getting a K1 at the end of the day.
That's correct. So they're going to participate as a limited partner, and they will get a K1 at the end of the year. And depending on how they have funded their initial investment, they'll either be able to take advantage of potentially any depreciation, depending on their situation. Now, as you have talked about in your other previously, about if you're doing an IRA, that depreciation is not necessarily applied because it's owned by the IRA. But if you are investing, by another means, then you are able to take advantage of the depreciation. And on these projects that we do, it is very common for us to do a cost segregation study so that we're able to accelerate the depreciation in year one, which is huge for a lot of investors. So it just kind of depends on what source of funds you're using for your investment.
All right, and the last question we'll get to, and then like I said, if anyone has any further questions after we go through this last one, please again reach out to Sarah, or if you have a question on the IRA side, reach out to me. I'll put my information up here in just a moment as well. The question came with the COVID crisis, senior living REITs have seen valuations drop by up to 70%. What do you see as the future of this asset class, and what liabilities do these assets have in terms of the health of the residents?
Yeah, I think that's a really good question, and that's really on the minds of all of the operators and investors in senior living. And with COVID, I mean, there's so much that we know what's already happened, and I've also watched those same REITs go down, and so it's going to be interesting moving forward on how that's going to play out. What's really critical. And again, this is going on as we speak, is that operators are working on changing up their policies and procedures and working with the regulatory agencies on, on keeping their residents safe. And so I think that's there's a lot of complexity around that. I can tell you that in the community that we were actually, from our operator standpoint that we're working with, they actually did have a COVID case in one of their homes. It was actually in their weakest home. They actually had residents who were in hospice in that home. But what they learned was the benefit of how they had operated was that in that small house model, they were able to quarantine and isolate that house very quickly once they realized that one of their residents were affected. So out of their 100 or so residents, that one resident that was affected, they quickly quarantined all of their other homes. And so moving forward, operators are going to, again, we talked about how to design and develop these senior living communities, and especially now with COVID impacts, that's definitely at the top of the list with a lot of these operators.
Sara, great information. Really good webinar. Enjoyed it a lot today. We've got a lot of people obviously on the call today too as well. A lot of good questions. So I want to thank you very much for coming on. We appreciate, again, as a topic we hadn't had anyone really discuss before. So it was good to get that fresh look at something new and something different that a lot of our clients haven't been exposed to, at least in the webinar environment. So thank you very much for coming on.
Thank you so much, Scott.
Yeah, and again, for anyone who is listening either live or listening to who is listening to the recorded version of this, please either reach out to Sara or myself with any other questions that you have. We look forward to seeing you on the next webinar. Sara, thank you again.
Thank you.